Hello and welcome to Martyn Lucas Investor. Thank you for tuning in to the main event. Today's event is all about the FOMC rate decision and the FOMC press conference. We will have the interest rate decision with us shortly. We will then go over to Jerome Powell and his press conference. We will then have a Q&A conference which is going to move the markets. We'll then have our own personal analysis from what Jerome Powell said. It's all about the details. And then we will come on to the earnings, Microsoft earnings. So let's get ready. The decisions are coming soon. We've got the full pre-analysis. We'll recap on that. We've got coverage starting as well now. So let's go straight over to the new coverage from Bloomberg, who's just gone live with their coverage. So I'm going to go over to, they've literally just started. So I'm going to go over to Bloomberg and then I'll give you my full thoughts and opinions. Thank you everyone for tuning in. If you've just tuned in, the one thing you can do to make my day is smash that like button and subscribe. We are minutes away from decision. So the countdown is now on. Let's go straight to Bloomberg and then I'll come back with the full analysis, everything you need to know.
Few times. The longer this goes on, the more likely it will be that it could be the Treasury Secretary.
It's an eclectic mix. I give him credit for that, but there's some names that are obviously missing. How you can not...
The corner
to be is a 25 basis point rate cut, and they're going to end quantitative tightening at the end of the month. I think those are pretty much baked into the markets. What are we looking for? It's all going to be about the post-meeting statement and the number of dissents. Are we going to see just Stephen Martyn frozen out by the rest of the FOMC and that one lone dot? I think pointing to 75 basis points in rate cuts and everyone else at 25, or are we going to see a couple others down in the 50 basis
Do you
point
think
rate cut
dissent
cap?
can cut both ways at this particular meeting?
I don't think so. I think the Fed believes that this is a risk management exercise. They've seen some softening in the labor market. They do believe that the neutral rate is somewhere below where they are now. So 25 basis points to me looks like the obvious place to go. I don't think there are going to be any dissents to the hawkish side.
With all your experience, we have a shutdown, we're blind, and we clearly have two Americas. The food line stories are heartbreaking, weighing in November 1. We've got a military that may or may not get paid. Who does the Fed think about today when they make this decision? Who does the chairman address at the press conference?
Well, I think they think about the broader economy and they look to relieve pressure on businesses and households. So bringing down the Fed funds rate by 25 basis points does have an impact on corporate America.
Yes.
A lot of corporate America, you know, we know from private credit, a 50 million EBITDA company could carry 350 million worth of debt. So it means a lot. And if businesses feel that the pressure is being relieved, then they may start hiring again or retain their workforce into year end, into the one big beautiful bill.
Okay, analysis starting soon. Get ready.
This afternoon, but it's not, because his mandate, given the politics of the nation and the national uncertainty, is he's got to get out front and surprise with a more dovish cast.
Perhaps that comes out at the press conference.
Yes, at the press conference.
I don't know, because as John started off, equity markets are at a high.
Okay, here we go. We are now getting very close to the decision. The countdown above my head is for the interest rate decision. Then we'll go into the FOMC meeting. The countdown on my other side is the flash sale. Everyone's been asking for this. It is a big day. There is a lot in the newsletter today. There is going to be a flash sale. We've never done this before. For the full newsletter, you're going to get a price that is pretty unbelievable. So let me give you a full analysis before we come on to that. Today's newsletter, I'll tell you what the newsletter is all about, and then this is going to be a very limited time. So what is the newsletter? Every single morning we come out with our very own newsletter. You get today's stories at a glance. Remember, this is for real investors. This is not for the people that come in and lose money every day. I mean, if you're losing money, then hopefully it will help. But this is not just for the random people that just want hype, that just want. There's a lot of people, especially in the XRP community, that always want $1,000 XRP tomorrow. Or there's people that will invest in BYND and just want to make 100% overnight. This is for people to start understanding what they're investing in, why they're investing in it, where we are in the market, and staying up to date with the real information, not just some random people on X or not just some random people on YouTube that just want to sell you leveraged products. This is a newsletter that comes out every single day. I basically quit my job so I can come on YouTube and provide this information for you guys. Every single morning, you get the top stories at a glance. That is, takes you 1 minute to read the top stories. You get that every single day. And that gives you an insight into what the top stories are. You get the one big thing. Today's one big thing is 99% probability, 0% surprise. The Fed is set to cut rates by 25 basis points today. That's what we expect to hear in 18 minutes' time. Already fully priced in by the markets. What isn't priced in is the language Fed Chair Jerome Powell uses at 2:30 p.m. Eastern Time press conference. A single word like appropriate or persistent could spark sharp moves across bonds, tech stocks, and crypto. In a market starved for clarity, today's real event isn't the cut, it's the script. This is not about... Oh, we've just got a super chat from Zach8. Thank you very much.
Zach donated $5 through a super chat. I want to scream, scared face emoji. Let's go.
We'll get through it. Zach, we'll get through it like we always do. If you have just tuned in, it takes 1 second. Hit that like button, subscribe if you haven't done so already as well. So that's what we expect. We know it's 25 basis points. If it's anything more, then it's going to be a massive surprise. If it's 50 basis points, the market's going to rally. If it stays where it is, the markets are going to crash. If it's a hike, then the markets will crash even further. It's going to be 25 basis points. A single word like appropriate. So what we look for now is everyone's pricing 25 basis points. We look for the words appropriate, persistent. This is the one big thing. It tells you exactly what's what the biggest thing to look out for is, and that is telling it to you there. The money move of the day. Don't chase the cut. Listen for the cue. This is telling you how to be a better investor. When a rate decision is a sure thing, the real edge comes from positioning around what comes next. Traders and investors often review Powell's language from past FOMC meetings to track shifting tone. Terms like liquidity tightening or restrictive policy offer insights into future moves for retail investors. Watching how assets like gold or Bitcoin react to Powell's press conference can be more educational than the cut itself. Very important. It's more important. In 30 seconds time, I'm going to give you access to this for an unbelievable deal. So this is the newsletter. Every single day you get information like this. The one big thing, the money move, the market snapshot, just giving you a quick idea of what's going on in the markets with the main indices we'll look at. Then you get the 5 things you need to know every day. Today, you looked at NVIDIA, the historic $5 trillion valuation of multi-domain infrastructure push. You got the main news from that, the 7 new AI supercomputers, the $1 billion Nokia investment, the launch of the NVQ link, and then you got all the analysis underneath. You got the US South Korea finalized trade talks, so you can pick and choose what you read. I recommend reading it all because this is going to make you a much more informed investor. You get the big earnings coming up. You get the altcoin ETFs launch. Using a loophole. You got the Boeing news as well, this 777, and then you got the deep dive for today. It's so important. You've got the full plan of today's and what to look out for the interest rate decision. We do this for CPI, we do this for stock reviews, we do this for crypto reviews. Every single day, you get the best information. You don't get this anywhere else. It takes 3, 4, 5 hours. Today, it took a lot longer to get do all the research. We do all the sieving. I'm subscribed to about 6 or 7 different news agencies. I look at the real news. I then filter it for what's actually important for you guys and then put it into a newsletter. You've got the on the radar, what's happening every single day in the markets. You've got the earnings that are coming up this week to keep an eye on it. You've got the chart of the day with my specific chart analysis. What I expect today is Microsoft because of the earnings coming up. So every single day you get that. And today, for the very first time, thanks to all the premium members that have made this possible, is we're doing a flash sale only for FOMC day. So we're probably going to change that timer into a countdown because it won't be available long. It will only be available during this event. So I'm going to take that off and I'm going to give you the link in the live chat. So if you've ever thought about getting the newsletter, if this is the first time you're hearing about it, go and check it out. Remember, you can get it on the app, you can get it on the internet, you can change it so you don't get it in your mailbox. You get all of that information. I'll tell you what else you get if you go on the About section, you get more You get the 5 things you need to know every day, the chart of the day, the big story breakout. You get the EV-Toll news or the EV-Toll newsletter from Vaz every Saturday. There's no ads, absolutely no ads in these newsletters. So yeah, why do we do this? You don't need the 5 different subscriptions or to scroll through fake news or next. I scan everything every morning, filings, earnings, crypto data, macro reports. You guys get the story. And this is what the premium members get. You get the full daily newsletter, no paywall. You get the daily deep dives. You get the chart breakdowns, technical zones. You get the EV-Toll specials. You get the one-on-one DM. You can literally message me any time of day. I actually reply personally. You got the full archive access. And the most exciting thing, which is coming soon, and it's going to make it much more valuable, is this whole Sensei's Investing Journal. I'm going to be telling you exactly what I'm buying and giving you a journal. We're going to be starting a stock portfolio, and you're going to get all the updates in the newsletter. So what am I going to do? I'm going to give you the link now ahead. We're waiting for the interest rate decision, 13 minutes. It's going to be unbelievable. You're not going to believe it. I'm going to pin it, all of that. I'm going to give you the link to get it. Let me get the link ready for you. This is a flash sale. This is today only. We've never done this before. That is all for 50% off. 50% off the annual plan. You get it right now. This is only available today. The live link is in the chat. I'm going to pin it. I'll tell you exactly how to do it. Let me pin the message first. If you see it in the live chat, it is 50% off for this event only today. So you can click that link. It will take you to this event here, to this page here. And you can get it for the FOMC 50% off flash sale. So this is the annual plan. It's now not $120 a year, it's $60 a year. That is less, that's about $5 a month. That is 1 cup of coffee you have to give up a month, and you'll get to be a much better investor. That's the annual plan. You select it. It's actually 67% cheaper than the monthly plan. Go and do it. If you're on the monthly plan, you might want to take advantage of the annual plan as well. So all you have to do is type in your email, make the payment, and you've secured a whole year of the newsletter for 50% off. So there you go. Now let's come back on to the analysis. I wanted to make that announcement while this event is running. It's going to be limited time. I think it's limited to maybe 20 people can get it. So yeah, it's first come, first serve, and it's only today. Let me go over to Bloomberg now. Let's see what they're saying.
Colleagues in Paris are going to be up late watching the Fed meeting. So I think that policy in the U.S. is going to be very important. That said, we're watching what the other central banks are doing as well. The Bank of Japan's been quite interesting this year. The ECB looks like they're almost done easing. So the Fed definitely leads the way, and you're seeing that price action in the bond market as well, where treasuries are rallying while other global bond yields are actually rising, and you're seeing that spread start to widen a bit.
There's a backdrop, Michael, here. I read very carefully, I think in the FT, about JP Morgan's new retail effort in Germany. Fascinating to see what digital banking is going to do. But part of it is a bang-up year for EM, a bang-up year of prosperity across the emerging markets, at least in the equity markets as well. So Jerome Powell, he's getting it done. Maybe even President Trump's getting it done. He's central banker to the world. That's all there is to it.
It feels like it, and also emerging
10 minutes away. 10 minutes away.
Well too. But it also feels to me that something's different about the ECB this go round. And I think Christine Lagarde looks at the ECB and looks at Europe and says, the sands are shifting. We have to ring fence Europe ourselves and deal with what's going on in Europe. So I expect them to veer away from the Fed over the coming year or so.
Extremely well said. And this is John. How much of the Draghi mandate has Europe actually got done?
Not enough.
Not enough.
Not enough. You know,
we are very close now, expecting 25 basis points. Then it gets exciting with the
first quarter
press
of 2025. If you look at the forecast from the ECB, you mentioned the European Central Bank. Let's go through them. Real GDP for 2025, 1.2%. 26, 1%. 27, 1.3%. If Chairman Powell was putting out forecasts like that in this news conference later on this afternoon, he'd be flat out embarrassed. And we've got analysts and strategists coming on the programme celebrating a new dawn for the European economy. Bob, that feels like a stretch based on the ECB's own forecasts. Is it a stretch?
Well, since those forecasts, you've also had Germany announced that they're going to embark on quite a large fiscal spend. You've got much lower policy rates now. I think you have to look across Europe and watch. I also think that the ECB is in a position where they could push through more unified issuance, create a joint vehicle that can fund projects across Greater Europe that rather than being raised in one particular region or another. So I expect good things to come out of Europe in the next year or so.
The focus this
we are
afternoon,
getting
of course,
ready
on
with
Federal
all the
Reserve and
charts.
The US Central Bank. That
Smash
decision
that
10
like
minutes
button,
away.
subscribe.
Subhadra Socigen still with us. Subhadra, TK said it at the top of the program. It's about QT. Potentially today, maybe you've got to wait until December in early next year. Is today too early, Subhadra, to make that call to end QT?
It's not too
It's
early,
all
but I
about
wouldn't be
QT
surprised
today.
if they decide that they want to wait. I mean, I don't see the rush either. I mean, yes, you are seeing some pressure on the repo markets. You are seeing the availability of collateral go up because there's been a lot of bill supply. Go up because there's been a lot of bill supply. The Fed could quite proactively engage in ending QT. But they can potentially employ other tools like temporary open market operations to allay some of the fears in the repo market and perhaps have a later start. Either way, the way I look at it is it's $5 billion or so in treasuries that they're running off their balance sheet every month, which is really a small amount. So if they end it, I don't really see that as a big market moving event. What it will do is help allay some of the fears in the repo market potentially.
Explain, Bob Michael. We need to do this, folks. It's a course here on the Fed Decides. Treasury Bill 101. We have more debt than God. The Secretary of Treasury has made clear he's comfortable with Treasury bills. Should our audience worldwide be comfortable that we're going to have massive issuance of Treasury bills in the coming quarters?
I don't think they should be concerned about it. When you look at money that's in cash, you can look at a narrow measure of money market funds, or you can look at a broader measure of M2, which includes deposit balances, checking accounts, and so on. There's a lot of money sloshing around
XRP
in the system.
top left,
and if Treasury
Bitcoin
bills
top
cheapen
right,
up a little bit,
S&P
that money
500
will
bottom
circle
left,
into it.
Ethereum bottom
there are
right.
also other things that could happen. One, stablecoin is growing wildly in the U.S. Treasuries are collateral for stablecoin, so you have a natural buyer base forming there, and nobody's talked about relaxing the SLR calculation for banks and removing treasuries from the denominator. The Treasury can do that. So you can even create larger buying pools for the front end of the Treasury market than what exists now.
I got to rip up the script here. It's too important. Richard Portis and his leadership at London Business School. I spoke to Professor Portis today. He has great concern about stablecoin. Your bank is known for a cautious approach here. You've amended that. But should we have worries when we study stablecoin, or can we say it's removed from the things John owns, Ethereum and Bitcoin and all that?
Well, I think you have to separate crypto and stablecoin. Stablecoin, which operates through the banking system, can be digitally tracked, it can be regulated, it operates within a banking framework. If it's collateralized by treasuries, it's safe, and then it allows transactions to occur 24/7, 365. There's none of this nonsense that on Thanksgiving, the rest of the planet's
Okay, so we are all set up. In 5 minutes, we're going to get the interest rate decision. This is going to get very, very heated quickly. Remember, interest rate decision, hold me to it. I say 25 basis points. Spam what you think in the chat. Is it going to be 25 basis point cut, 50 basis point cut? Is it going to be a hike? Is it going to be a pause? Spam it in the chat. Let's see who's right. I think it's 25 basis points. The market is now rallying into this decision. Some people are saying 50 basis point. I don't think so. Then it gets important when the decision comes. When we get the press conference, I'll do a full analysis and after analysis. After we get the interest rate decision, it's going to be 25 basis point. I'm going to give you the full analysis because we'll have a little bit of time before the press conference, which we're ready for. Everyone's spamming in the chat. So what is everyone saying it's going to be? We've got 50 basis point, 25 basis point, 50. Oh, wow. We've got a few people saying 50. It's not going to be 50 in my opinion. I would love to be proven wrong. I don't think it's going to be 50. 25, 50, 25, 25, more than 25 basis point. Well, it's going to be 25 or 50. I don't think it's going to be more than 25. Pause, someone said. 35, well, they won't do that. And Ninja says 25. DJ Haynes says 25, 25, 25 December. That is Charlotte May Weddings. Spot on. That's what I think is going to happen as well. Gary says 50. If it's 50, the market will rally. If it's 25, the market won't really react. If it's a pause, the market will crash. If it's a hike, the market will crash even more. The market's priced in 25%. I'm saying 25%. I think that's going to happen. We have just released a flash sale for our newsletter. Go and check it out. It's 50% off. The first time we've ever done this. Go and I'll give you the link live in the chat as well. It's only going to be for this event. Someone I think mentioned that they can't upgrade from monthly. The one thing you can do to make sure you secure it is just sign up with a different email and cancel that one. I apologize if it doesn't let you upgrade from monthly to this. But yeah, for anyone who hasn't got in, it's a flash sale, 50% off the newsletter. If you're a real investor, every single day to your inbox, you get the full news. It's filtered. I look at it. I spend about 4 hours every day doing it. All the news that matters to you as investors. It will make you a better investor. 5 things you need to know. The 5 top stories, deep dives, whether it's analysis of crypto charts. We've got a chart of the day as well. Whether it's crypto, stock analysis, specific stocks, CPI, inflation, Fed, FOMC. Today is all about FOMC. We'll be referring to it in a second. Every single day, you will get that in your inbox. You can get it on the app, web browser, or in your mail. So you get full flexibility over it. It is a 50% offer today only. It's worth it, says Yolanda. Thank you very much, Yolanda. You are a supporter of the newsletter as well. No matter the outcome. If you want 50 basis cut, why? Explain the reason. Why do I want a 50 basis point cut? Well, because that will fuel the market. A 50 basis point cut will send a signal saying that quantitative tightening is probably coming to an end. 50 basis point cut means that people can refinance lower. The market loves to see 50 basis point cut. It basically means, well, people don't really want to hold bonds because bonds will drop yields. People will want to go into gold. They want to go into the the stock market because they'll get better returns there. It also means that borrowing is going to be cheaper. So as long as the market can handle a 50 basis point cut and inflation is not sticky, 50 basis point is good. And today, if we get a 50 basis point cut, it'll be amazing. I don't think we will, but in 2 minutes time, we'll find out. If you have just tuned in, hit that like button, subscribe if you haven't done so already. It takes 1 moment to do both of those things. Please consider doing it. 1 second, hit the like button. If you hit the like button, it might be 50 basis point, and I might be wrong. We'll find out. Hit that like button, takes 1 second. Subscribe if you haven't done so already. Let's go back to our coverage. 105,882. We can get this higher. Subscribe if you've just tuned in. We're going to give you the full analysis today. Let's go over to potentially Bloomberg. Let's see if we can get Bloomberg. I think we'll keep Bloomberg on the small screen down there, and we'll tune into them now because this is going to get very, very exciting. Remember, we'll have a little gap where we'll give you our full analysis, but stay with us because the FOMC conference is 10 times, 20 times more important. Let's see if I'm right. 25 basis points. Is it going to happen?
On what he's going to be doing at the December meeting, although they don't have a whole lot of information.
I'm just going even more live. Then let me just mute that. What I've done there is sometimes you can do it as well. If you press the settings and press ×4, you get even more live than anyone else. So we are as live as we can be.
Beyond
here we
that,
go.
somewhat here there, but now we have this shutdown. You said the word when we came in here in our show preparation. The
markets are pumping into this.
Odd.
It's an odd one.
You said it's an odd meeting.
The only data we have, the most recent data, the only data we have is inflation and headline and core around 3%, and the Federal Reserve set to cut interest rates at 25 basis points. I understand why, because they're worried about the labour market, but it's a kind of awkward situation not to have that official labour market data and still to be looking to cut interest rates.
XRP top left, Bitcoin top right, S&P 500 top bottom left, Ethereum bottom right.
It's out the window. We'll have to see.
That Fed decision just around the corner. Let's check out the market. Start with equities. Equities this afternoon positive for a 5th consecutive session on the S&P 500
Here we go, it's
up by
refreshing.
0.2. In a bond market on 2s, 10s and 30s. A snapshot
What do you think
of
it's going to be? Put it in the chat.
At the front end of the curve by 2 basis points. Likewise on 10s. With that Fed decision, here's Mike McKee.
A divided Fed cuts their benchmark lending rate by 1/4 percentage point and says they are going to end QT December 1st. There are two dissents.
They're going to end QT.
As policymakers reset the target range to 3 3/4 and 4%. No surprise, Stephen Martyn dissents in favor of a 50 basis point cut as President Trump wants. And Kansas City Fed President Jeffrey
Smash the like button,
dissents
subscribe.
on the other side in favor of no move. The Fed's administered rates for interest on reserves and the primary credit rate mechanically decreased by 1/4 percentage point along with the Fed funds target. As for the balance sheet, the Fed will stop redeeming maturing Treasury securities at the end of November. Principal payments will be rolled over going forward. The mortgage cap of $35 billion a month remains in place, but as of December 1st, all principal payments on maturing agencies will be reinvested in Treasury bills. Fed officials gave a nod to the government shutdown in their economic assessment, noting that, quote, available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting downside risks to employment rose in recent months instead of have risen. And uncertainty about the economic outlook remains elevated, they say. There is no change to their forward guidance. The statement still says in considering additional adjustments to the target rate, they will consider many factors. Guys?
Mike McKee, stay there. What a decision.
Let's look into this. They're going to analyze this. This is going to be important. And then we have Jerome Powell.
Expected. The MQT, a lot of people were talking about that coming into the decision. But the headline here is just how divided this committee is. Dissent cutting both ways. One saying keep policy unchanged, another saying let's go even harder and cut by 50 basis points. Equities stay elevated, up by 1/4% on the S&P 500, but a bit of a turnaround in the bond market. Switch on the board against the fixed income, 2s, 10s and 30s. Bond yields just slightly higher by 3 basis points on 10s at 4.01%. TK, these aren't major moves in financial markets, but there is a subtle shift in this Federal Reserve. It's divided, and when you're this divided, it's difficult to provide guidance about what you're going to do next. Because if you're trying to lead this committee, trying to reflect a consensus that doesn't exist,
everyone
is
can comment
impossible.
now.
Edge of Bank of England. It's the first thing I thought about. I've got to go back and study when the last time this really happened, where you had one up, one down, one hawkish, one dovish as well, pushing against the chairman. And it speaks to the two parts of the country that are out there. My idea that there's two R-stars. You see it with the shutdown again, and part of America flat on their back. You've got, it's amazing to me to see Martyn 50 beeps in, John, and let's say you want to go the other way, it's a 75 beep gap. I don't believe I've ever observed that. I'm sure I'll stand corrected, but there it is.
The last time we had a dot plot, there was massive dispersion. I think you know whose dot's at the top now, and we knew whose dot is at the bottom. Mike McKee, I believe, is still with us. Mike, the credible argument here, are there credible arguments to do nothing and credible arguments to go even harder?
Well, the credible arguments to go even harder are a little bit harder to make because financial conditions are pretty easy.
Stay with us for the analysis.
And the markets have been soaring in recent weeks. No change there. We did see interest rates rise a little bit this week as perhaps the markets got a little concerned about inflation going forward. Jeff Schmidt's case is probably easier to make in the sense that inflation is still rising, even if we are seeing the Fed cut rates. That could only be a problem going forward, is his view. And there are people on Wall Street who certainly share that.
Michael McKee, thank you, sir. You get into the news conference. Mike McKee there breaking down this decision. The Federal Reserve reducing interest rates by 25 basis points this afternoon.
2019, we had George and Rosengren say no rate cut at all, and Bullard said a dovish dissent. That's some of the tension, but I would suggest today's meeting has even greater tension than what we saw in 2019.
Wow. Okay, wow, this is going to get interesting. This press conference is going to be a fun one to watch, that's for sure. We're going to get Jerome Powell on the stage in 25 minutes. The rate decision is out. 25 basis points. I was right. There we go. I'm always right, aren't I? So 25 basis point. Great, brilliant. That's what we expected. The market likes it. However, what is going on is actually a lot of uncertainty within that decision. Some wanted more, some wanted less, Some were in favor of a 50 basis point cut, some in favor of a 25 basis point, some in favor of no cut at all. That is what the market is worried about. Uncertainty. No, the Fed not agreeing on something. That's sometimes worse than the actual outcome. So that's what the debate is right now. What is the feeling in the Federal Reserve? XRP now selling off, Bitcoin now selling off, Ethereum now selling off, the S&P 500 is struggling to hold on. It all depends on what Jerome Powell says to us in 24 minutes. Where can we get the information? Well, let's go over to our very own newsletter. I'm going to go over to this newsletter. I'm going to tell you what this newsletter is, and then I'm going to tell you everything you need to know, because Jerome Powell is going to speak. That's when it's going to get volatile. I'll tell you what, exactly what he might say, and depending on what he says, we're going to pump or we're going to dump. I'll tell you all about it right after I tell you about the newsletter. The newsletter comes out every single day to your inbox. Every morning I send you a sharp, no fluff market rundown, built to get you in, informed, moving before the herd. This comes out before the bell every day. If you're investing in the markets, you need to know this. You need to get this. You get very simple 5 things you need to know every day before the market opens. You get the chart of the day, all the key levels, what I'm looking at. You get the big stories, the deep dives every single day, whether it's a stock review, a crypto review, a macro event, a data event. You get the full analysis like today. You get everything you need to know about the FOMC. You get the tools and thinking points to real conviction. Tomorrow, I'm going to probably give you an analysis of what happened today so you can understand your investments. So this isn't passive reading, it's a dashboard, it's a cheat sheet, it's your first win of the day. Why does it exist? You don't need 5 different subscriptions. You don't need to scroll through fake news on X. I scan everything every morning. Filings, earnings, crypto data, macro reports, and global headlines, so you don't have to. When you read Sensei's insights, you get hours of really real research distilled into minutes. It's not AI or algorithms, it's me. I filter what matters to you guys and I put it together. If you want more context or questions, or if you just want to message me, you can. This newsletter, you can press direct message. You message me, I message you at that time. So I left my job to go all in on one mission to help you cut through the noise and take smarter actions every single day. No hype, no shills, no ads, no sponsorship, just research tools that signal that make sense. So what do premium members get? It's normally £89 a year. It's normally $120 a year, but today it is half price, first ever discount. Very, very, very rare that we will ever do this again. This is the flash sale. It's 50% off. It's live in the chat. As a premium subscriber, you'll get the full daily newsletter, no paywall. There is a monthly plan and a free option, so you can click. You can still click it and get the free plan. But today, 50% off. It's the price of a coffee a month. Just cut down on 1 coffee a month and get all the news. You get the weekly deep dives. You get the weekly Evtol events. You get the daily deep dives as well. You get the chart breakdowns and technical zones every single day. You get the charts. You get the Evtol newsletter on a Saturday. You get the one-on-one DM access. You get the community access. You get access to everything you've ever missed. If you missed any of the newsletter and you wanted to understand what was in it, you get it. And also coming soon will be the Sensei's Investing Journal. So all the stocks I'm going to be buying, when I'm going to be buying them, why I'm buying them, with full analysis. It's not financial advice, but it's going to be giving you the full context of why I'm buying it. So there you go. Go and check it out. Nothing is financial advice, but it's today only for this FOMC event. And now we're going to go over to the analysis. So let's go back to Bloomberg, and then I'll give you my analysis ahead of Jerome Powell speaking 21 minutes. That link is live in the chat. All you do is click it, click the annual plan, and then you can sign up. Here we go. Let's go back. Actually, the market's now pumping again. The markets don't know what to do after this information. Back to Bloomberg for their analysis. And then the most important part is in 21 minutes time with Jerome Powell.
I think we're all familiar with how they respond to, say, non-farm payrolls, the unemployment rate, and CPI. But if you don't have that anymore, Rich, how do you communicate?
Well, it's tougher. There are alternative sources, ADP for employment, and, the Billion Prices Project for prices. But I would agree, John, the further this goes on, the trickier it gets really to make an affirmative case, especially right now. Let's be honest, the justification here in September and now is really a risk management consideration. And, but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment. So risk management becomes trickier as well.
The market is undecided.
John Farrell and I took Behave Yourself 101 and Don't Be Rude, so I'm not going to ask this of Vice Chairman Claret. I'm going to ask it of you, Bob Michael. We have Chris Waller with a definitive 1991 paper on game theory. and the Fed. He and I covered that the other day. We have Richard Clarida with arguably the definitive 1999 paper on not so much the history of monetary policy, but the mechanism that we have. How critical is it to you and your bank that we have a next chairman who has prodigious monetary chops?
It's important. You need to have someone there who understands that the Fed, I believe, controls the purse strings to the U.S. economy. So it's an awesome responsibility. I think Rich hit the nail on the head. You don't only need a dovish Fed if you're the administration. You need a persuasive appointment to head the Fed. And that's a rare combination. And there's one guy we know in the administration today who's been shockingly persuasive. If you go back to April when everything was falling apart.
Okay, that's enough from Bloomberg. I've got the exact criteria you need to know before Jerome Powell goes live in 18 minutes. Stay with me. The first thing you need to do is hit that like button. The second thing you need to do is subscribe if you haven't done so already. So from our very own newsletter, today's deep dive was all based off this. Let me give you a quick rundown of what we are expecting today. So I'll keep the charts open so we can keep a good eye on what's going on. XRP's top left, Bitcoin's top right, S&P 500's bottom left, and Ethereum's bottom right. So, yeah, I told you, the Fed cut is priced in. The language isn't. The markets haven't really reacted massively to that because it wasn't a hike, it wasn't a pause, and it wasn't 50 basis point, exactly like I said. And I said in the first sentence of the deep dive of today's newsletter, the 25 basis point rate cut is a foregone conclusion. Priced in, I said, with a 99% probability. Investors must look beyond the words spoken by Chairman Powell. They must look beyond the action to the words that will be spoken by Chairman Powell at 2:30 p.m. Eastern Time. That's in 17 minutes. There's people leaving the stream right now because they thought it's all about the 25 basis point cut. They are wrong. It's not about that decision. What it's all about, it's all about what Jerome Powell now says and what the press conference Q&A will show. So let me tell you more about that. So the expectation is a few rate cuts. That is still the expectation. Now we need some more guidance from Jerome Powell, so we'll see what he says about that. Right now, we're expecting 3 rate cuts. We're expecting one that we already had in September, so 3 rate cuts in 2025. One that we've just got today. We just got that announced at 25 basis points, and then the market's pricing in one for December. If we start seeing more people vote for a hold, because we saw the issue right now, and the reason the markets don't know what to do is because some people said hold, some people said 50 basis point cut, some people said 25 basis point cut. It's all about December now. Are we going to get that rate cut in December? I thought we were, but now there's some people saying we shouldn't cut rates. What's Jerome Powell going to say in the press conference if he hints at the fact that we need more data and we don't need to cut rates so quickly, then the markets might dump because that will take away what's priced in. And right now, what's priced in the market, if you go over to the Fed watch tool, if you go over to December the 10th, our next FOMC meeting, we are pricing in a 25 basis point rate cut once again. If Jerome Powell alters from that and says something a little bit different, that suggests that the market will come down. But the good news was we were waiting for quantitative tightening in the newsletter today. We said if he says it's coming in the coming months, it's a massive unpriced liquidity shock. And it is. It's great. People this is actually really good news. We've just got the announcement that in December the 1st, in 2 months or in a month from now, we are going to get QT ending. That is incredible. That's a liquidity shock. That's great for the markets. So that's really good news that we've got. The market should be up based off that news, but the reason we're not up is because there's a bit of uncertainty within the Fed. Some people want cuts, some people want to stay where they are. That is what's going on. And as I said, the issue right now is, where did I write this, is the disagreement. We literally had this in the newsletter this morning. The market's firmly priced in 3 total cuts. However, the critical disagreement is over the path for 2026, and that's what we're talking about. There is disagreement at the Fed. That is why the market doesn't know how to react. Look at those charts on the bottom right. They're down since that announcement, really, they are. And that's because of there's disagreement within the Fed. Some people are saying in the Fed that we need a cut. Some people are saying we don't need a cut. Some people, that disagreement is causing the market to be down right now. The September dot plot implied minimal cuts after 2025, suggesting the Fed expects economic stabilization. It's a stark contrast. Anyway, I'm not going to read that part again because we've gone through this analysis, but I want to pick up on the key points because in 15 minutes time, we're going to have Jerome Powell live on the show. So, wow, look at these charts. We're going to have to start moving them down. The S&P 500 is now trading quite down. The XRP top right, you can see that it's coming down. Bitcoin, XRP top left, Bitcoin top right, that's been down since. It's all because of what we spoke about here, the critical disagreement at the Fed. What else do we talk about? Well, this is the part we're not got onto yet. This is Jerome Powell's language. We're going to see Jerome Powell speaking in 15 minutes time. So 15 minutes time is Jerome Powell coming out and speaking. And I guess this is what's going to really move the markets. It's going to be a pump or dump. We've got good news, which is quantitative tightening ending in December. Brilliant. The market should be up on that. But it's the issue is the disagreements within the Fed. So that's why the market is up, down, doesn't know what to do. It's actually edging on the way down. It all doesn't matter because this is what's going to mark whether markets go up or down. It's Powell's language. I told you 100% it's a 25 basis point rate cut. What we need to wait for is Jerome Powell speaking. So Powell's language blueprint, the dovish versus hawkish tells. The market's post 2:30 p.m. Eastern Time reaction will be defined by Powell's linguistic nuance. Seasoned investors watch for specific vocabulary that signals the path ahead. So here are the words to look out for. If we want to hear Jerome Powell be dovish, what does that mean? That means we want dovish shows that there's money being injected into markets. It means that there's more rate cuts on the way. That's a dovish Fed. So what we want to hear from the Fed is essentially things like inflation is not a problem. We want to focus on the jobs market. We see further rate cuts coming. Liquidity conditions are tightening. We are at a very restrictive rate and we want to come back more to a neutral rate. If he describes the current policy as inappropriate, if you start saying words like the where we are right now with the rate, it's an inappropriate rate for where the markets are, then that could signal that we're continuing. If he says anything about the cutting cycle continuing, that's dovish tone. If he says inflation is not a problem, that's a dovish tone. If he says tariffs is a one-time issue, that's a dovish tone. What would be hawkish and push the markets down is stuff like persistent inflation. If you start saying inflation is pretty persistent, if it's sticky, or if he warns against premature easing, if you start saying we shouldn't ease the rates too quickly, that is always, markets are heading back up a little bit now. If he starts talking about premature easing or warning against premature easing, that basically means, wait, we shouldn't cut rates so quickly. We don't want to prematurely cut rates. Trixie is saying quantitative tightening means that the central bank removes money from the economy, usually by selling government bonds or letting them expire. Yeah, reducing their balance sheet instead of buying up the balance sheet and providing liquidity. Yeah, so they're ending that. They're ending the selling of bonds and adding more. Anyway, yeah. So quantitative tightening is coming to an end in December. More liquidity will be in the market, so that's a good thing. We've gone past that. I was just seeing someone spamming in the chat, so thank you for letting everyone know. If you have just tuned in 10 minutes away from Jerome Powell, please do hit the like button. Please do subscribe. We're reading from our very own newsletter today, and there was a flash sale, the first time ever, maybe the only time ever. So if you do want to get the annual plan, it is the price of a coffee a month. Please do go and check it out. It is a flash sale today only for the FOMC. We're reading from it now. We gave you all the analysis. Everyone who read this before would have been prepared for exactly what happened because that's what we said. And now we're prepared for the actual meeting. So here is the link. It's live in the chat. It's 50% off. So there you go. So hawkish keywords. We've talked about the dovish keywords. Hawkish keywords we've just talked about. Persistent inflation, sticky inflation. We don't want a premature ease. We don't. That would be a sell-off. That's when the markets will come down. We talked about the restrictive rate. We are at a restrictive rate right now. That's why inflation's coming down. They might start talking about that neutral rate. What is that neutral rate? What does the market? What does the interest rate need to come down to? Well, the Cleveland Fed says between 3 and 3.77%. That's quite a range. 3 to 3.7. 3 to 3.7. So some people, that means one more rate cut. To others, that means another 4 or 5 rate cuts. No analyst knows exactly what's right. That's why in 2026, we're going to have quite an issue with knowing where the Fed's going. Hopefully, Jerome Powell gives us some guidance, and hopefully it's guidance towards the lower end of that, maybe a 3% neutral rate. But again, if we hear about 3% neutral rate, that's great. If we hear about 3.7% neutral rate, or if he suggests that not many more rate cuts are needed for a neutral rate, then the market's not going to really like that. 77% probability current rates are currently restrictive. We know that. There is major issues in the market. We've got consumer stress. Credit card balances are back to all-time highs, over 1.21 trillion. If the interest rates stay high, people are just going to keep defaulting, and it's not great. Student loans, 10% are now 90 days plus delinquent. That's not great. We've got the corporate debt wall. If interest rates stay high, or if you suggest they stay higher for longer, the issue about that is in 2020, everyone got near 0% interest loans. If they and it's coming up for refinancing between 2025 and 2027. If they don't get those lower loans, the spreads will widen, and over-leveraged firms, especially things such as the Russell 2000 stocks, will start crashing because they don't have money to keep going. We've got Q4 earnings, which is going to affect all of this. Tonight, we're covering Microsoft straight after Jerome Powell. Is this an AI bubble? I don't think so. I mean, yes, it's overvalued. Yes, we are trading above, we're pricing in for perfection, but is it a bubble? Maybe it's a bubble, but it's not like 2000. 2000, that .com bubble was very different because not many companies were making money. Now companies are making money. If you look at the top of this newsletter today, look at that main story we put in today. NVIDIA, what is NVIDIA up to? Well, it's just hit a $5 trillion valuation. Yesterday, it dropped a flurry of game-changing announcements. 7 new AI supercomputers for US national labs powered by Blackwell GPUs. $1 billion Nokia investment to build AI-native 5G and 6G telecom infrastructure. Launch of NVQ-Link bridging GPUs with quantum processors. Massive AI factories from XAI, Lambda, Uber, Eli Lilly. Bluefield 4 release, enabling 800 gigabytes per second throughput for next-gen data centers. All of this happened yesterday. This is a super mega company which has ties with everyone now. That's why it's the first $5 trillion company. They're making money. Other companies are making money. AI is making people more profitable. And that's why there is that reason the markets are up this much. Can it crash? Yes, be prepared for a crash. But can it continue going on? Well, yes. I mean, some analysts are saying 5-8% more in the S&P 500. I'm saying that the crypto bull run can continue if we get good announcement from Jerome Powell today, if all earnings beat. Essentially, I'm not here to tell you the market's going to go up forever, and I'm not here to call for a crash tomorrow. Be prepared for all scenarios. Please be prepared for all scenarios. If you're a long-term investor, it doesn't matter. Just buy, hold, look at it in 10, 15 years. If you're a swing trader and you want to get better prices, well, if it's up and you need the money, well, you might want to take some profits. Or maybe take 10, 15% profits in case it drops down and you want to buy back in. Or what I do is I buy, and if we're overvalued in the market, which I think we're slightly overvalued in the market, I don't buy any more at these levels. I just start piling in with cash or gold and silver. And then when the market crashes, I buy in. So that's why with my XRP position, I'm 50-50%. I'm 50-50. I don't know. Sometimes I know the market's going to go up. I'm very confident the market's going to go up. That's like in a bear market when we bought XRP at 30 cents. I thought that was a great price, and I thought it would go up from there. Sometimes I know we're at the top of a euphoric peak because we've got so many indicators saying that, and I'm like, okay, I'm going to sell 80%. And sometimes it's 50-50. Right now, I don't know if we're going to continue euphoric for another 5-10% on the S&P 500, another 300-400% on the crypto market, or if we're going to crash tomorrow. And if it's times like this, I make a decision. Well, what's the risk to reward? For me, the risk to reward is I want the reward of staying in and going to towards the upside so I can take profits, because all indicators to me are suggesting we should have another euphoric run. But also, maybe we get a crash. And if we get a crash, I've accumulated cash and I'll buy lower. So have a plan for each scenario. I use the charts to help me. I keep up to date with all the newsletters. Obviously, I write them. So if I didn't have access, I'll be signing up to something like this. And I think this is the best way of doing it. And keep up to date with all the information. So that's how I'm navigating the markets. Remember, nothing I ever say is financial advice. It's my thoughts and opinions only. So please don't buy or sell based on anything I say. If you want access to this newsletter, you can see you've got all those stories at the top, 5 more of them. You can see you've got this deep dive, which tells you everything about the FOMC, all the earnings, the economic calendar, when everything's going on, the chart of the day. I'm looking at Microsoft today because of the earnings. All of this, every single day to your inbox. There is a first ever flash sale of 50% off the annual plan for your first year. So go and check it out. The link is in the live chat. It's literally this event only. Jerome Powell speaking in 5 minutes. Let's talk about a bit more. I don't think we're at .com valuations. In the .com era, no one was really making money. Now they are making money. It's amazing. Look at what Nvidia did yesterday. It's incredible. Analyst price targets are another 5 to 8% up on the S&P 500, the ones that think we can go higher. UBS is calling for a recession in 2026, a 93% chance. Tariffs, there's a risk of escalation, there's a risk of inflation, there's a risk of dollar weakness, so there is risks. Tariffs looks like it's going to be a one-time hit, so I don't think Jerome Powell's going to be worried about that. Inflation, Jerome Powell's always going to be worried about inflation because he doesn't want another uptick. You can see the charts at the bottom right. Everything is waiting for Jerome Powell to start speaking in 4 minutes. Let's keep an eye on all of that. Yeah, nothing yet. Yeah, we've got Jerome Powell ready to go. And then the final euphoric phase. If you start looking at previous cutting cycles, 12 to 18 months after that euphoric rally, you get the eventual peak and crash. Look at 1998 with the peak in 2000. Look at 2019 with the peak in 2020, 2021. The current cycle sort of really began in September of 2024. I know we didn't get many rate cuts this year, but we started again. So the real cuts began in 2024. If you go sort of 18 months ahead, you're looking at June, August, June of 2026. So that metric is suggesting June of 2026 could be that final peak. I think it might be a little bit earlier than that. Some say it could be next week. We don't know about that, but everyone is suggesting at some point there will be a crash that will bring us lower than the values we were at maybe a few weeks ago. I would say between a 20 and a 40% crash is on the way. At some point, but there can be that last euphoric run. So Bitcoin and altcoins are pure liquidity plays. So QT end is deeply bullish for crypto. Altcoins will enter their high beta season when Powell definitively confirms QT is ending and signals a clear path for further cuts. We got the first part. QT is ending. December is ending. Second part, we need Jerome Powell to give us a clear path to say interest rates will continue coming down, inflation is not a problem, to be super dovish, and then we get all the ETFs and cryptos can keep going up. So final investment mandate. Again, this is not financial advice, this is my thoughts and opinions. So tonight's 25 basis point rate cut is irrelevant, and I told you I was so confident it's 25, I worded it like this. It's irrelevant. 25 basis point cut, irrelevant. We knew it. The directional move for next quarter rests on clarity regarding 2 key words from Powell. QT, he'll talk about it, but we've basically got confirmation December it's ending, and the 2026 rate path. Let's see what he says about the rate path. Dovish surprise. Explicitly confirms QT will end this year using appropriate for balance sheet reduction, and signals a clear path for December 2026 cuts. We need that path. He probably won't give it to us in all honesty, but if he gives it to us, then we can continue being euphoric. If that happens, then I'll be allocating to risk capital, small caps, altcoins. I'll stay in the market. If we get that hawkish nuance, if he emphasizes persistent inflation, I don't think he will, or tariff concerns, my reaction would possibly be to de-risk from that tech exposure, crypto exposure, and monitor bond yields for rising real rates. I might be going over to Treasuries, just like Martyn is waiting for that opportunity to come back in. The objective is to validate the path forward towards a full easing cycle, another 75 to 100 basis point cuts to the end of QT. If validated, the foundation for a volatile but profitable euphoric phase into 2026 is confirmed. There it is. Now we know the analysis. We can go straight into Jerome Powell's speech. You can see the market down here is, you got XRP over, how do I point this way? XRP over here is basically sideways since that decision. Bitcoin over right below me is sideways. The S&P 500 is bottom left on that chart. That's down slightly to near the lows of the day. Is it of the day? No, it's the lows of the last sort of few hours. And then you've got Ethereum, which is staying elevated. So we're waiting for Jerome Powell. He's coming to take the stage. If you liked all of that information from the newsletter, you can get it every day on every main event. Remember, the top things you need to know every single day. You could just get it to get the stories at a glance as a free plan as well. The one big thing, the money move of the day, what I'm looking to do, the market snapshot, the 5 things to know every day, the top main stories, Nvidia, Trump, deals, altcoin ETFs, XRP ETF, Boeing company. You've got the Fed. The Fed cut is priced in, the language isn't, I told you. And now we've also got the chart of the day, the earnings, and the economic calendar at a 50% off deal, never done before. So let's go straight over to the Fed, waiting for Jerome Powell to take the stage. If you want that, here is the link. There is the link. The flash sale, 50% off. We've never done this before. There is a link. Go and check it out. Let's go over to, how should we do this? Let's have the charts open over here. Jerome Powell is taking the stage. Here we go.
By 0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments.
Please hit the like button, guys.
Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it.
Please subscribe and hit the like button.
Preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the
really not good what you just said there? Really not good. He's literally saying that might not cut rates at all in December. He's making it very clear.
Debt.
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December? Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds. Steve.
Guys, please do hit the like button, subscribe if you haven't done so already. The market's crashing. I'll give you my whole analysis. The market's down not 50%, but the newsletter is. 50% link is in the chat right now. The first time we've ever had a sale. Let's go back to Jerome Powell. The issue, I'll explain all the issues in a second.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, We'll be
subscribe.
We didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Martyn with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services, and that's kind of been moving sideways over the last few months. But a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, We're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views. So on that division then you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board? Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Schulze with ABC News. What is your
Full analysis
explanation
coming
for
up.
why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on. But it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think, some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths, maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or may be skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than.
Guys, please stay with me. The analysis, I've got a full analysis. I'm putting it together, all the key quotes. I'm doing this in the background, so stay with me. As soon as this ends, I'll give you the full analysis, my full thoughts. The markets are bouncing back. There is a 50% offer on the newsletter today only. Flash sale will be ending. Please do subscribe. Please do hit the like button. I am here working in the background for you guys, getting all that information together. Stay with us.
Mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. the economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up. But job creation is very low, and the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, I mean, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. I mean, inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two, and so it's a challenging thing. And as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it, and that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions, but we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
That wraps up the news conference from Chairman Powell.
Okay, I've got the full analysis.
Rates by 25 basis points. Credit to that reporter and to Mike McKee for actually asking about financial conditions and financial markets. If you are just joining us, welcome to the program. Equities recovering. There was a drop-off as soon as Chairman Powell started to speak. We're back to about negative 0.2% on the S&P. The bigger losses on the Russell, the small caps down by 0.8. In the bond market, off the back of these comments from Chairman Powell, bond yields higher at the front end of the curve by 9 to 10 basis points.
Worst time to leave the show would be right now. The worst time for you to click off the show would be right now, because you don't know exactly what went on. I have spent that whole time doing the analysis behind the scenes. The worst time for you to click off this show would be right now. So stay with us for at least another 5 minutes to see what I have to say. You should stay longer than that, but let me just see what I have to say. Don't click off the show now. Worst time to click off the show. Let me give you the full analysis. So, what has just happened is very interesting. I've got the key quotes. So what I'm going to start with actually is getting those key quotes to you. Firstly, just look at the markets. The markets are back to where there was that initial sell-off. The sell-off is now sort of nothing. It's come back to neutral. The market's going to digest this information. Well, let's digest it together first. This is the information. So the key policy moves there was 25 basis point rate cut. We are now at 3.75 to 4%. The big announcement was QT has ended. QT will end December the 1st. Quantitative tightening is ending. The balance sheet will be held steady. No easing, but QT ending. That was one of the main points. Remember, I'm going to actually send this out to all premium newsletter subscribers. I'm going to clean it up, get it done nicely, get you a fresh piece of, and we're going to put all these quotes together. All premium newsletter subscribers expect this. Remember, we are running our flash sale. It's ending in 33 minutes. It's the first time we've done this. If you have looked at our newsletter, it's I would say it's one of the best out there. Every single day, you get the top stories at a glance. The one big thing, the money move of the day, the snapshot, the 5 things you need to know. If you're investing in the markets, you really need to get this newsletter. No ads, no sponsorship. The real news. I subscribe to about 10, 15 different news sources. I put it all together at 4 hours in the morning. You've got the NVIDIA momentum there, and then every day you get that deep dive story as well. Today was all about the Fed cut. You would have been fully prepared for this if you had the newsletter. You've got the calendar every single day as well. The earnings that are coming up this week. We've got Microsoft coming up right after this, so don't go anywhere. Microsoft earnings is coming up. You've got the chart of the day. Today is Microsoft because of the earnings. So if you want this newsletter, you get it first time ever at flash sale, 50% off. Give up a cup of coffee once a month and you can get this whole newsletter. There won't really ever be a deal like it again. So I'll give you that link in the live chat. Let me just copy that over, give it to you. I've got the full analysis that's coming up right now. So worst time to click off the show would be right now, because I'm going to condense everything Jerome Powell said. You might have not been listening carefully. You might have not been paying attention. You might have been dozing off, but don't worry, I'm going to tell you everything. So there's the link, flash sale. All you have to do is click that link. You'll get this whole analysis after, and you get the daily newsletter as well. The annual plan, that brings it down to $60 a year. I mean, it's 67% cheaper than the monthly. even if you don't want to pay a cent, at least sign up for the free plan. You'll get some of the newsletter. There's a founding member if you want to become a founding member of the newsletter. Let me just turn that countdown off. Let me go over to what's actually happened. So go check out the newsletter. I'm actually just going to put, we're going to cover Microsoft earnings in about 15 minutes time. So stay with me. Let me change that countdown over to Microsoft, because we'll be covering Microsoft very shortly. Just going to put a countdown for Microsoft. There we go. That's when we're starting. Oh, that's the wrong one. Why did I do that? 1 second, I'm going to give you the full analysis. Stay with me. If you haven't hit the like button yet, if you haven't subscribed, what are you up to? Please do hit the like button and subscribe. That will be amazing. Martyn said I'll get a bonus if we get 107,000 subscribers. We're on 106. I don't think we can make it happen, but give it a good go. Let me say, instead of analysis, it's earnings. Let me change that. Earnings in. Okay. Okay, let me give you the full shebang of what Jerome Powell said. So thank you for sticking with me. Hit the like button, subscribe. 25 basis point rate cut. That's what's happened. What else has happened? QT is ending in December the 1st. That's great. We've got acknowledgement of the softer labour market. Downside to risk of employment have increased. That's good for rate cuts. Inflation has seemed somewhat elevated but manageable. We didn't want to hear him say elevated, but he says they're elevated, but they're manageable. So pretty good. Risk to inflation tilted up, but policy balance has shifted. So here are the key quotes. There's about 20 of them. Here's the key things from all of that we just heard. What are the key quotes? And I'll tell you if they're my thoughts on each. So we decided to lower our policy interest rates by a 1/4 percentage point. That's what we got. 25 basis point rate cut. I told you before, that was in the newsletter. People said 50 basis points. People said no rate cut. Some people said hike. I said I'm very confident 25 basis point. That's what happened. We also decided to conclude the reduction of our aggressive securities holdings as of December the 1st. That is great. That's a liquidity injection. Dovish. Job gains have slowed significantly since early this year, so that's showing the labour market is in trouble. That's why they're cutting rates. A large part of what's happening is a reduction in the supply of new workers, lower participation and immigration. We're at the stage where there's not. He's saying there's not that much supply of workers out there, so there is low participation due to maybe immigration as well. If job, and I'm going to tell you, I've got this table down here of what's bullish, what's dovish, what's not. Just some of the key quotes. Jobs, where were we? A large part of what's happening is a reduction in the supply of new workers, low participation and immigration. He also said if job creation, once you adjust for overcounting, is close to zero, then maximum employment is not sustainable. He then said, when you are in that situation, it's appropriate to support demand with our rates, and that's what we've done. He's showing why he's cutting rates because of the job situation. We judged it appropriate to take another step forward towards a more neutral policy stance. Remember, we talk about that neutral policy stance. No one knows where it is, and he mentioned in that speech, whatever the case is, we are 150 basis points closer to that neutral rate because of the rate cuts from last year. So he's saying we understand there's a neutral rate. He didn't really confirm where that neutral rate is. I assume he can't really do that. But anyway, he says we're closer. And again, they're moving towards that neutral rate. If you're driving in fog, you slow down. Now, when he said that, the markets didn't like it because he's essentially saying, wait a second, are we going to have a cut in December? A cut in December was priced in the market. Now is it going to be priced in the market? Well, maybe the market will continue pricing in a rate cut in December, but if we don't get that rate cut in December, which he says might be likely, that's when the markets crash. December, when we get the next FOMC meeting, that's when the markets can be caught off guard. Maybe the market just doesn't care about what he just said. It continues to price in a 25 basis point rate cut. It comes to December and they don't cut rates. That's an important thing to take away from today. So he said the continued shutdown makes it more difficult to make a move in December. He's literally telling us maybe we don't get that 25 basis point rate cut. The market is still pricing in a 25 basis point rate cut in December. So that's key point to take away there. Tariff inflation is likely one time, perhaps a few additional attempts through spring, then it'll stop adding to inflation. He's saying that's great. He's saying tariffs we can ignore. It's a one-time hit. Not great for the consumer. However, we don't have to worry about it here in the Federal Reserve. Inflation away from tariffs is not so far away from 2%. So he's actually saying our rate of inflation right now is quite close to 2%. Ignore tariffs, we're quite close to 2%. That's why we can keep cutting. Again, pretty dovish comment there. Consumers are still unhappy because price remains much higher than they were 2 or 3 years ago. AI-related layoffs are something we're catching carefully, though we don't yet see it in claims. So he's saying there's not actually people losing jobs. And this is what Fed Waller was talking about last time in a speech, about the fact that AI is going to take away jobs, or is it? Or are companies going to save enough money that instead of laying off, they're actually going to start hiring more people? Well, he's saying we don't have evidence of AI-related job losses at this moment in time. Policy is meaningful, less tight than it was, but I wouldn't call it accommodative. We are now in the range many estimates estimate as neutral, between 3 and 4%. He's saying we're getting close to that neutral rate. We are now in that 3 to 4%. So this is where it gets a bit tricky, where they navigate what is that neutral rate. Again, if you want to read all about the neutral rate, look at today's newsletter issue. We talk all about it. Some on the committee think it's time to take a step back, while others think stronger and see where stronger growth is real. Remember, that was the key reason the markets didn't really rally, because there was some people saying 50 basis points, some people saying hold, some people saying 25 basis points. It's that inconsistency within the Fed itself. I'm just going to check this because we've got an earnings coming up, and that will actually have a bigger effect, because there's a few big earnings tonight, and that might actually have a bigger effect than this. But by the way, it seems this Federal Reserve meeting's gone, the market hasn't actually pumped or dumped really. The earnings could be the one that moves it now. So stay in tune. We're going to have Microsoft earnings as well coming up. So we are now in the range many estimate as neutral, between 3 and 4%. Some on the committee, yeah, we read that one. We're trying to end this cycle with labour market in a good place and inflation on its way up to 2%. Now let's look at these a bit deep, 10 of these a bit closer. So end of the balance sheet runoff, QT. That is dovish. Liquidity support returns, tightening phase formally ends. That was one of the most bullish things they said, is QT's ending in December. Great. That sort of injects liquidity into the market. Emphasizes on rising, there was a lot of emphasis on rising employment and supply side labor constraints. That's dovish. He's saying the shift from inflation first to job stability is a priority. He did acknowledge that the job creation is near zero, so there's not that many jobs being created. And again, if there's not jobs being created, that's a labour market concern. That shows that the markets need to come down. You can see these are all dovish. Neutral stance and balanced approach. Signals pivot from restrictive to neutral footing. Let me keep this open over here. Neutral start, yeah. Where were we? So yeah, if you're driving in the fog, you should slow down. This is the part where some would say it's dovish, some would say it's not. It favors caution, slower pace of policy moves. I wouldn't say that's dovish. I apologize. Obviously, I'm doing this very fast. So yeah, I wouldn't say that. I would say that's actually slightly hawkish when he talks about slowing down the rate cuts. Tariff inflation one time. Tariff inflation is one time. Non-tariff is near 2%. Remember when he said tariffs is more likely to be a one-time hit and then maybe tiny bits in the spring and then it ends? That's quite bullish, because he says we're not going to worry about tariff inflation. And then he said that if you take away tariffs, we're quite close to that 2%. 2% is all they care about inflation. So if inflation's at 2%, they should cut rates to bring it down to a neutral stance. So he recognizes the demand and uneven economy. December cut is not a foregone conclusion. This is what the market hated. This is what the market crashed on. He's saying, and he took it a step further. I think he even mentioned he took it a step further, essentially saying, don't rely on a December cut. It's not a foregone conclusion. Actually, he made a comment saying that this is different to before, when he said it's not a foregone conclusion. He said he really does need to. They really don't know if they're cutting or not. So that's hawkish, and that's when the market crashed or came down. We didn't really get a crash on our hands today as expected. So yeah, it's just that December situation is what we should be slightly concerned about. What else did we want to cover? Yeah, policy meaningfully less tight, but not accommodative. That was neutral. It positions the Fed between easing bias and vigilance. He then also said we're now in the neutral range, 3 to 4%. That's dovish to neutral. Implies tightening compete, validates pivot zone. So it does start saying that he has basically said in that comment that the neutral rate is between 3 and 4%. So that basically means maybe 2 or 3 more rate cuts, and then they're done. Then they're at the neutral rates. The market might didn't take that too well as well. They want it to be closer to 3%, then 4%. But again, that's going to be the debate of the century. Where is that neutral rate? So yeah, I'll be sending this out to all premium members. I'll clean it up and add more to it. So that'll be addition to your daily newsletter. Remember, the monthly subscription cost is going to be going up on the newsletter. Remember, I'm going to be doing that portfolio updates on the newsletter. I'm going to be analyzing each stock that I'm investing in. It's definitely not going to be a buy at this level, sell at this level sort of situation. I'm not doing alerts. I don't want to tell people to buy or sell. I'm going to sort of having my own journal where, what am I buying? Why am I buying it? Here's the full analysis. This is why I buy these stocks. I'll be doing that on the newsletter. That should hopefully be coming in the next few months. So if you want to get prepared for that and you want to take advantage of the 50% off subscription and take advantage of the daily newsletter, the link is in the live chat, so do go and check it out. It's the flash sale, 50% off. I am going to send you over to Vaz now. So Vaz, if you can go live now, I will send everyone over. This is actually going to turn out to be more important than what's the market doing after all of this. Yeah, market's selling off a little bit, but what's going to happen now? Vaz is doing Microsoft earnings. There is also going to be a couple other mega earnings that Vaz, I'm sure, will cover and have a look at Meta, Google. So Vaz, if you don't mind keeping an eye on Meta and Google and seeing how their earnings goes as well. Vaz is now going to go live on this channel in 1 minute. This is going to be more important. The Federal Reserve meeting will analyze. I'll give you more tomorrow. But there was nothing shell-shocking. There was nothing that was going to pump it, dump it. What can happen now on the bell? Literally, we're going to be live in 1 minute, and the results will come out in 10 minutes. That first thing is going to be earnings. 3 earnings are going to come out. Financial results from the 3 big stocks. This has a real impact on 15% of the S&P 500. These 3 stocks. So literally in 10 minutes time, you're going to get 3 pieces of data that come out. Vaz is going to be covering it. The market's either going to crash or pump based on how good they do. Remember, the market's priced for perfection. They need to be on earnings. If they don't beat on earnings, the markets can come down. We've covered the whole FOMC today. Now we're sending you over to Vaz to cover the earnings. So Vaz is going to be, Vaz, you can go live. I'll send everyone to Vaz now. So thank you everyone for tuning in. Stay exactly where you are. Don't leave. In 10 minutes time, you're going to see a reaction on the market. Microsoft, Google, Meta, all with Vaz. Please say Sensei sent me when you go over to Vaz's show. It's live on this channel. It's going to take you directly there. I'm going to give you the link to that show. But before you go, we might never have a sale like this again. The flash sale, 50% off the newsletter. Get the newsletter tomorrow. I'll send you this FOMC analysis and a lot more to come. Thank you guys. Hope you get your bonus anyway. We didn't hit 107,000. Maybe if we get it on Vaz's show, I'll still get it. And it's gonna, I'll talk to you all tomorrow. Remember, we're live every single morning with our morning forecast show, 12:30 UK time. I think that's about 8:30 Eastern time. Or 11:30 UK time at the moment, but yeah, 7:30 Eastern time, something like that. Go and check it out. Live every single morning on this channel. I will talk to you all there. But now it's... Oh, Yolanda, thank you so much for being here. I'll talk to you all tomorrow. Now it's important to go to the earnings. So there is the oh, that's the wrong one. That is the newsletter. Here is where we're going. The show will automatically take you there. Click on this link now. It's the YouTube link. This is Vaz, who's already going to hopefully be live when I click this. Is he live? He's not live right now, but he'll be live any second now. So he'll be live now. Okay, thank you, everyone. I'll send you over to Vaz. He's live right now with the earnings. In 10 minutes' time, you're going to get a big impact on the market. That's because Microsoft, Meta, and Google are going to be reporting. Vaz is going to cover it live. Until next time. Oh, Saab, lovely to see you here. Until next time, take care of yourselves and each other. Straight over to Vaz now. The flash sale will be ending in 17 minutes. Thank you for everyone who signed up, and thank you for everyone who tuned in for the Fed meeting. I'll see you tomorrow morning. Vaz is live with the earnings now. Bye-bye.